Most people think that the emergency room should be purely about saving lives. But for a financial analyst, an emergency room represents one of the most stable, recession-proof business models in the entire world. That is, unless they need the emergency room themselves. While most industries have to navigate the constant up and downs of consumer spending, healthcare operates under a completely different set of economic rules. And over the last decade, some of the world's largest investment firms have placed multi-billion-dollar bets on this specific corner of the market. But as one massive $10 billion collapse recently proves, the transition from the boardroom to the emergency room is anything but a simple one. In this video, we're gonna look at three things: why Wall Street wants to buy more emergency rooms, the biggest private equity failure since this takeover began, and what this means for you going forward. Because really, this is just the beginning of private equity buying up US medicine, and it will impact all of us. Let's dive in. If Apple suddenly doubled the price of all their iPhones, my guess is many would make the switch to Samsung or Google phones, even if they loved Apple. There's just simply a limit to what people will pay, and this spans across almost every single industry. Cars, streaming services, designer clothing, pretty much every industry except medicine. If one of your older family members is having a heart attack, you don't really care what it costs, you just want to get them help and save their life as fast as you possibly can. And this is exactly what makes the emergency room so attractive to private equity. It can be extremely lucrative. It's called inelastic demand, meaning the demand for emergency room care won't go down if prices go up. You can virtually increase prices as much as you want without ever running out of customers completely. Couple that with the fact that emergency rooms spend hardly any money at all following up with patients compared to a normal doctor's office, and you have an extremely attractive investment, especially if private equity adds in their secret sauce to eventually make even more money. But hold up, before we get into all that, why would a hospital or emergency room even want to sell to private equity? What do they get out of it? Well, if they're publicly traded like some are, they may not really have a choice. In the US, if a company trades on the New York Stock Exchange or NASDAQ, meaning you can buy their stock, then they must have what's called a board of directors. These board members have a fiduciary responsibility to act in the best interest of the company and its shareholders, those who have invested in the company. So if private equity comes and approaches them with a fantastic offer, something that's considered way more than the company is trading for on stock exchanges, then they must at least consider it. And that's exactly what happened to Envision Healthcare, a public physician staffing company that was offered $9.9 billion to sell to private equity. No one would predict, though, that in just 5 short years, it'd be considered the biggest private equity disaster in the history of US medicine so far. In 2018, one of the biggest private equity firms in the world, KKR, approached Envision Healthcare with an offer they couldn't refuse, $9.9 billion. Roughly 30% higher than where Envision's stock was trading at the time. Financial documents revealed that Envision's board believed that this deal would give investors the most value. Envision Healthcare had two businesses: M-Care, a physician staffing business that placed doctors into emergency rooms and intensive care units, and AmSurg, an ambulatory, meaning walk-in, walk-out, surgical center that did outpatient surgery. Basically, 25,000 medical professionals worked for Envision, and they had more than 780 medical facilities. They were huge. Now, real quick, some context here, since I know there's usually a shroud of mystery around the words private equity, but basically there's no two private equity deals that are exactly the same, but they follow a fairly consistent playbook usually. At a basic level, a private equity firm studies a business, they decide what it thinks it can grow or fix, and it makes an offer to buy it, usually using a lot of other people's money. The fund itself usually has about a 10-year lifespan, meaning they spend the first few years buying companies, then the back half trying to improve them and eventually sell them for big profits. General partners, the managers, are the people who do the work to improve the business, and limited partners, the investors, the people who got all the money, get the profits. And if they wanted decent returns, they just invest in the stock market. Instead, they usually target 16 to 25% annual returns. That means they usually need to double or triple their money within 5 to 7 years. So how do they do that? Well, the author of the book, The Private Equity Playbook, Adam Coffey, points out 3 ways that at least he does it. Number 1, pricing. Can they get the emergency room to charge more, renegotiate contracts, improve billing? Number 2, volume. Can they expand locations, add services, or acquire competitors? Number 3, pivot. Can they bundle services and sell you more at the ER, move up market, or build a broader platform? Context over. Now, when KKR bought Envision Healthcare, 70.7% of the $9.9 billion they bought it for was debt. Reuters said that KKR's takeover Envision was one of the largest leveraged buyouts since the 2008 financial crisis. But KKR didn't mind taking the risk here because at the end of the day, that debt was going to be on Envision Healthcare's plate if anything went sideways. So look at this from the perspective of the private equity company KKR. They knew Envision's business inside and out. They knew about healthcare's inelastic demand, and they had a secret sauce strategy up their sleeve that they knew 1000% would double, triple, or even quadruple the money that Envision was making from the emergency room. All they saw were dollar bills, but there was something significant that they overlooked that would come back to haunt them. And it had everything to do with that secret strategy I keep mentioning. In the US, if you go to the emergency room that your insurance has a contract with, you're gonna likely pay less money. You still probably pay too much money, but it beats the alternative. The alternative is if you see a doctor out of network, or if you see a doctor who doesn't have an advantageous contract with your insurance company, then you're gonna get one of those crazy medical bills you can't even believe the hospital can legally charge you. Well, Envision staffed hospitals and providers with emergency doctors, which meant that while many of the hospitals and providers were in network, they had a contract with your insurance, many of the doctors that Envision staffed there were actually out of network. So going back to that family member of yours that's having the heart attack, if they had been seen by an Envision doctor at one of your local emergency rooms, you may have been hit with a surprise medical bill that was significantly more than you expected. The emergency room showed up as somewhere that would accept your insurance, and you don't find out till afterwards that you're being charged an additional $14,000+. Researchers from Yale, the New York Times, and professors writing from the American Prospect argued that Envision Healthcare was doing this to patients. Eileen Applebaum and Rosemary Batt said Envision was loading patients who sought emergency care with often unpayable medical debt. They said that was KKR's secret strategy to increase profits. Well, around this time, a law was gaining popularity called the No Surprises Act, protecting people from situations just like this, surprise out-of-network medical bills. The one thing I think KKR neglected when they bought Envision Healthcare was to take into account that healthcare is the most regulated industry in the United States, and popular opinion has a major impact on new regulations. When the No Surprises Act went into effect in 2022, it ruined Envision. With some creativity, Envision and KKR were able to split Envision into two companies and keep the one that was doing well, AmSurg, as a profitable asset, but the other, Envision Physician Services, was forced to file for bankruptcy. Look, this isn't a private equity hit piece. I know that this is just the beginning of PE buying and selling healthcare companies, but we need to find a way that's going to be mutually advantageous for stakeholders, private equity companies, hospitals, and most importantly, patients. In this example, KKR looked at Envision Healthcare and applied their same old strategies, but to healthcare. And I'm aware that big equity firms like Blackstone, Apollo, and KKR aren't mission-based PE firms. Their goal is to get good returns. This is capitalism, that's just how the game is. But that one single strategy is simply predatory, and it will inevitably lead to further regulations. Private equity by nature must focus on short timelines, but going straight for the predatory low-hanging fruit of surprise billing will do more reputational harm than good. And ultimately, it will invite the very regulations that will kill future private equity returns. If you found this video interesting and you'd like to see more like it in the future, please consider subscribing for more. This is Tyler Dutchover. Thanks for watching.